coming to the perspectives of the German investment market, what it is the investors are looking for, when you start with the market and what it's going on there, is Germany is seen as a safe haven. You see it quite clearly when you look at the government bond side. Government bonds are at historically lows in Germany, and although they are now converging from some of the regional Eurozone countries back to the German levels, they are still above the German levels, and Germany is still seen the safe haven that people want to invest in, that people want to go for. That has to do something also with the economics and the fundamentals in the background. At the same time, what you have to see today, the Eurozone will stay here. That's at least my opinion on the markets for the years to come. And what you can expect then, that government bonds might shift in the next 3-4 years when we sorted out the Eurozone problem. So the Germany is a safe haven that people want to be in. And that is also supported by the fact that if you look at the total return figures on the European countries or the Eurozone countries, you see that Germany has a red line down there. It's not a flat line we've seen for house prices in a lot of the markets, but it's something, a return between 0 and 5% that you get. It's no large ups and downs like you see in the UK market or some of the Nordic countries, for instance, like Sweden or even the French market in France. So Germany it's a little bit of a boring or let's say not very interesting market from that cyclical point of view, but it's definitely the market people like. The security, it's plannable. If you try to plan ahead, you're quite sure what you get in the markets, what's coming on. So looking at this, that's also very closely mirrored in the volatility of the markets. When you look at the volatility of the markets, Switzerland is the only market with a low volatility, but you arguably would agree on that Switzerland is a little smaller than Germany, so the real estate market that is investable in Switzerland offers you much less opportunities out there than in the German market.
And arguably, what's the other point is, it's much easier possibly to buy in Germany than in Switzerland. Because not only is the Swiss market very closed, but also if you look at residential, for instance, as a foreign investor, you have to find some quite fancy structures to be able to invest in Swiss residential real estate, because normally they don't allow any foreigners to do these kind of investments. You might have some, if you have good lawyers, you might find fancy structures to get around it, but at least that's not the market. So Germany is by far the market where that is big. It's the largest economy in Europe. It's the second largest real estate market in Europe, but it's a market with a very low volatility. It's predictable, and I would say arguably it has a legal system a lot of people understand, maybe not all, but it's something where you can work out of. And it's much lower volatility, for instance, than the UK. That is the most liquid market. So when looking for safe haven investments, Germany is one of the points where the investors are focusing on. But at the same time, if you look at what's going on, I mentioned it already, the challenges are continuing on the economic side. We don't see any rationale for interest rates rising currently, so all the investors, institutional investors, they have to look for some kind of yielding investment. Government bonds are nice, but if you have a return of 0.1% or let's say if you have a 10-year government bond, Germany is 1.2, 1.5%, whatever. So that's not very sexy if you have to pay out requirements from your shareholders that are way above 1.5%. So real estate is one option for a lot of people to go, because legally stocks, maybe it's not what they're going for. At the same time, stocks, it's insecure. You never know what the stock market is doing. There's a lot of ups and downs, so the risk is much higher. On the other side, what we really have to mention, regulation is still an issue, especially for the real estate market. It's also, if you look at Germany, regulation is an issue. We don't know exactly how the regulation will impact the transaction market and the availability of finance in Germany, and that can be an issue. So at the same time, that makes it clear why a lot of people, when they focus on properties, focus on core and core-like properties, because they are quite sure that financing and exit might not be that of an issue. Talking about core and focus on core, though, so you see that prime rents remain under pressure. That is looking at 42 European markets, and green is the markets that have falling prime yields, and red are the markets with rising prime yields. But what you also see is that the market is a little bit of polarizing, that you have markets where prime yields are rising again. And that is not only the PIX countries, that's also some cities in the UK regions that you see. While on the other end, with the falling yields, you have some of the German cities, and you have some of the core property markets in the UK, for instance, or in the Nordics. So that you have the polarization of markets that people think they are secure and that they're focusing on. And if you look at the investment prospects of the regions in cities in Europe, that's the ULI Emerging Trends Survey, you see there are only three cities that are deemed with good investment products. That's London, one of the bigger real estate markets in Germany, in Europe, and then you have the two German cities, Berlin and Munich, where the people think that the investment prospects are good. I would say mainly driven by the fundamentals, because if you look at, for instance, Munich, that's the economic hub of Germany. I think it's 5 or 6 DAX companies are headquartered in Munich, so that's where you have an economic fundamental for driving the city, driving rental growth, driving also space demand. On the other hand, Berlin, it's quite fancy actually, it's a capital of Germany, but on the other hand, what I just mentioned from Munich with the DAX companies, in Berlin there is no single DAX company headquartered. That's something very unusual for European countries. And that's what you have to keep in mind. It would be that in Paris, no French CAC 40 company would have their headquarters, and I think that's unimaginable for France. And it's also not imaginable for the UK that one of the FTSE 100 that none of the FTSE 100 companies would have been their headquarter, would have a headquarter in London. But in Germany it's the case, and that's also a little bit of one sign why Germany is much more than the capital city. You have much more smaller cities where the companies are located, a much more diverse structure where you have to be aware of, because that's what drives the single markets outside the capital. On the other hand, Berlin is a market that has been incredibly cheap for, let's say, 10-15 years ago, because after reunification you had a building boom, and then everything collapsed from the mid-90s till the end 90s. And after that it took a while before investors, let's say, re-entered the Berlin market, and that's possibly why a lot of investors currently think that Berlin is an interesting market to be in. And I would agree on that, but you have to be careful where in Berlin you're investing. Looking at the overall investment intentions, I titled it All on Germany but with higher returns. So that's more or less what the investors want. They want to focus on Germany and to a certain extent on the Nordics. And if you look at investment style, what was told to INREF was that a lot of investors are now looking for value added. Core is still king, or core is what the people want to be, but they're now also, as INREF said, moving up the risk curve for value add. I a little bit disagree on that, because I think the people don't want a higher risk, they just want a higher return. So they're moving to value add because they need the higher return and not because they want to go for the higher risk. So that's also what you have to keep in mind. So if it's broken core, value add or core plus, the people are just going there because they have a higher return and not because they want to have a higher risk. And that's also what we see when we talk to our investors. They happily agree on everything unless it's core risk profile. How you classify that, that's more or less they don't care about. They just want to return 4.55%, but please give it with a core risk profile. And that's something you have to be aware of. You don't get it. There might be some special situations where you find it, but in general it's not possible to have in Germany. Looking at the overall investment landscape, Germany is comfortable in second position after the UK. It's the second biggest investment market, and at least the gap between the UK and Germany closed down a little in the last quarters after the financial crisis. So that's also a little bit of a sign that the German market is now much more liquid, more transactions are taking place. So looking at the German investment market in the last, let's say, 7-8 years, transactions have increased substantially since the financial crisis. But what is also seen here is that residential is on the rise again. Residential is a story everybody focuses on in Germany, and as the slides here is only focusing on portfolio transactions, you really have to say that the share of residential in overall transactions is a little higher. Actually, it would be around, let's say, 35-40% if you look at single unit sales or single property sales, which are not included in this database because there simply is no one accounting for all the single building sales in residential that are taking place. But residential is a substantial part of the investment market in Germany again, and I would personally say they are to stay for the next 2 or 3 years. At the same time, the the anxiousness or the scare, everybody's scared of a bubble in residential real estate in Germany. But I want to remind you on one thing. What is a price bubble? A price bubble is a broad-based price increase that is disconnected from fundamentals. And I would say if you look at Germany currently, you have a price increase in certain cities, in certain agglomerations, but it's not a broad-based price increase. You still have declining prices in some regional cities and some rural areas. And what I also want to tell you is, if you look at the left side of the slide, is it's not that much disconnected from the property fundamentals. Rents and prices in the segment of new build apartments have moved more or less in line with each other in the last 5 years. So it's not a disconnected price movement from the rental factors. And if you then add in the fact that a lot of people are still moving to the urban agglomerations in Germany, that demand is increasing, and that although construction is rising, we are still building far too less residential apartments compared to what is needed, there is no price bubble. You can still say there are price exaggerations in certain segments of the residential market, and I would agree on that. But it's not a property or price bubble as it is defined from a purely economical and theoretical point of view. But I have to agree, having a publisher of a magazine here, that it's much nicer to write about a price bubble than about price increases disconnected in certain segments of a market. So it's much better headline talking about a price bubble.
Nonsense.
On the other hand, if you're looking at the office market and looking at what I mentioned with government bonds, that is a little bit of the talk about the yield spread. It's a prime yield of the top German 5 office investment locations compared to the German 10-year government bond. And you see that at least the spread is on an all-time high. And you can happily argue, is the 10-year government bond the right comparable? Because rental contracts have become shorter, so possibly a 5-year bond might be a better comparison. But then the spread will be even higher. But one of the things you have to keep in mind is, why is this spread so historically high? And I would argue possibly it's more like that you have a pricing on the a bubble on the bond market, because everybody is rushing for safe haven assets and is not pricing in really what's happening on the bond market in Germany. So, but what would this mean when interest rates go up, possibly in 3-4 years? What will happen to prime yields then? Will the risk premium just diminish as it has on the just after the millennium? Or will yields start moving out again? Because a lot of people, when you talk to them, they say now real estate has a decent risk premium, it's correctly priced according to bonds. But if this is the case, then if bond yields go up, property yields will have to go up. Because there's no much rental growth perspectives in the German market in the prime locations currently. There might be some rental growth looming on the horizon in 3-4 years, but currently I would say the rents will stay more or less flat, so the yields are more or less driven just from the income side, not from rental growth perspectives. And possibly to go forward, as the bond yields won't go up, I would imagine the prime yields in Germany might come down a little further, but not that fundamentally. And then if you look at the last 13 years, they're just fluctuated between, let's say, 4.8 and 5.5, which is in a European comparison also a very stable environment. And for prime yields, they're relatively high compared to what we have seen in other European core markets. If you look for Paris, you had 3.75 just before the crisis in prime CBD. You had in London, you had 3.75 in West End offices. Something Germany never had seen, something below 4.75, maybe 4.5 in a single market, but they never moved lower. So they are still relatively high compared to what you get. And then if you say it's a safe haven market, you have at least a better return than some other safe markets, I would say. Looking at Germany, what I mentioned already is the markets are very diverse. I just plotted in the top 7 locations on the right with unemployment rate and population growth perspectives. And what you already see is that even in the top 7 markets, there's a lot of diversity in Germany. So Munich, Stuttgart, Berlin, Cologne, they just behave quite different when it comes to unemployment rate and population growth. And if you then look at the map on the right-hand side, which shows a little bit of the metropolitan areas in Germany, you see there's much more in between of the 7 cities that are typically the focus of most investors. So there's much more out there than the 7 cities that are covered more or less intensively by the real estate agents. But that's also the little bit of the problem in Germany. We have a federal structure and we have a lot of smaller markets that are important for the region, but it's very hard to monitor them without speaking German and without being local on the ground, because they're simply not monitored that closely by the international real estate agents. So you need someone who knows the market to help you to understand what's going on in these markets. On the other side, if you look at the financing market, it's an issue in a lot of countries. In Germany, most of the players say, yeah, the financing situation is unchanged and it will be unchanged for the, let's say, next 6 to 12 months to come. It's a very good financing situation. If you look out on the German market, especially the local savings banks, the Sparkassen, they are an active player on the financing side. If you have a property in one of the smaller cities, the local Sparkassen will be happy to finance it if the LTV is around 50-60%. So they are one of the big players. And the current financing situation, improving it is on the residential side, because a lot of banks are trying to get in the residential segment again. But as the survey also shows you, most are expecting that this improvement in the conditions will stop now, because you can get a very low margin already, and I wouldn't say that the banks are really can compete the margins much lower, because it's simply they have to have capital costs, they have regulatory costs that are mounting, so there will be much more to come. On the other hand, that's a lot of talk that debt funds might take over some of these, possibly in some other European countries, but I don't think in Germany they can really operate successfully, because the margin environment is quite low. The competition from savings banks and other banks is quite high, so I would say a debt fund idea for Germany is maybe not the best you can get. Other European countries might be different. What I found quite interesting when looking at the market in Germany is CMBS market and the share of foreign investors in the top 5 locations. And at least if you look at the issuance of CMBS and the share of foreign investors in the top 5 locations on the right side, they seem to follow a little bit. So as the share of foreign investors is going up in the top 5 locations again, possibly we see a little bit of a revival on the CMBS market in the years to come, which might help to get in some of the debt that is needed for the not so core properties, the value-added opportunistic properties that are the books of the banks, because the banks have to put the borrowers have to put in additional equity that they don't have. So the question is, if the bank currently on a way to extend the loan, that's the only way to do it. If the CMBS market opens up again, there might be a way to get some debt capital from that side. So that might be one of the prospects for, I would possibly say, 2014, 2015 onwards. I don't believe it happening this year, but from next year or in 2 years' time it can, from my point of view. So that's the start of the discussion. So that's a little bit of the points I put together. It's the market for risk-averse investors. Pricing looks attractive, but you have to be aware of the bond bubble in Germany when you compare it to the alternative assets. The federal structures offers you a multitude of investment locations in all sectors. It's not only residential, office or retail, you also can look at the logistics side. Germany is one of the countries where goods are shipped through, when they come from east to west, they're shipped through Germany, so it's a logistics hub, just because everything is transferred, unloaded, and you repacked and ferried on. And financing outside the residential sector remains challenging, but it's still available, and it's also available on very good conditions. So thanks for your attention.